Mutual funds are a sort of investment that is popular among retirees and long-term investors. Mutual funds enable investors to acquire a diverse range of assets in a single investment. Mutual funds are corporations that aggregate investor capital to buy stocks, bonds, and other assets. Mutual funds enable most investors to build a more diverse portfolio than they could on their own. Index funds, bond funds, and target date funds are all part of the mutual funds group. Mutual fund investors do not physically control the fund's stock or other investments, but they do partake equally in the fund's total gains and losses, hence the mutual in mutual funds. Mutual funds are a low-maintenance approach to invest in a variety of assets at once. Inside a single mutual fund, you may have exposure to hundreds of stocks, bonds, or other investments. Mutual funds are popular among investors who do not want to select individual investments but want to benefit from the stock market's historically high average annual returns. The costs and performance of a mutual fund are determined by whether it is actively or passively managed. Passively managed funds invest in order to outperform a certain benchmark. They attempt to replicate the performance of a market index, such as the S&P 500, and so do not often necessitate expert management. As a result of the fund's decreased overhead, passive mutual funds frequently have cheaper fees than actively managed funds. Mutual fund types for passive investing. Here are two prominent types of mutual funds for passive investing. Index funds are made up of stocks or bonds that are listed on a certain index, thus the risk and returns attempt to mimic the risk and returns of that index. If you own an S&P 500 index fund and the S&P 500 is up 3% for the day, your index fund should be up around the same amount. ETFs are traded like individual equities but provide the diversification benefits of mutual funds. ETFs typically have lower minimum investments than index funds. ETFs may be less taxed than index funds. Actively managed funds have a professional manager or management team that makes investment decisions for the fund's money. They frequently attempt to outperform the market or a benchmark index, but studies have shown that passive investment strategies often outperform. If you're ready to start investing in mutual funds, here's a step-by-step instruction on how to do so. Your first decision is possibly the most important. Do you want to outperform the market or try to copy it? It's also a simple choice. One strategy is more expensive than the other, yet often does not produce superior outcomes. Actively managed funds are managed by professionals who monitor the market and buy with the goal of outperforming it. While some fund managers may do this in the short term, it has proven impossible to consistently outperform the market in the long term. Passive investing is a more hands-off technique that is gaining favor, owing to the convenience of the process and the outcomes it may produce. Passive investing typically has lower fees than active investing. Consider your budget in two ways to assist you decide how to proceed. What is the cost of mutual funds? One tempting feature of mutual funds is that once you meet the minimum investment level, you frequently have the option of deciding how much money to invest. Many mutual fund minimums range from $500 to $3,000, however some are as low as $100 and a handful have no minimum at all. So, if you choose a fund with a $100 minimum and invest that amount, you may be able to contribute as much or as little as you choose in the future. You might invest in a mutual fund for as low as $1 if you chose a fund with a $0 minimum. Aside from the required initial commitment, consider how much money you have to invest comfortably and then select an amount. Which mutual funds should you put your money into? Perhaps you've opted to put your money into mutual funds. But what beginning fund combination is best for you? In general, the closer you are to retirement, the more conservative investments you may wish to have. Younger investors often have more time to ride out riskier assets and the inevitable market downturns. Target date funds, which automatically reallocate your asset mix as you age, take the guesswork out of the "what's my mix" question. When investing in equities, you'll need a brokerage account, but there are a few possibilities with mutual funds. You're probably already invested in mutual funds if you contribute to an employer-sponsored retirement account, such as a 401k. You can also buy directly from the fund's creator, such as Vanguard or BlackRock, although this may limit your fund selection. You can also acquire funds through a typical financial advisor, but this may impose additional expenses. Most investors purchase mutual funds through an online brokerage, many of which provide a diverse range of products from various fund firms. If you use a broker, you should think about affordability. Mutual fund investors may be charged two types of fees: transaction fees from their brokerage account and cost ratios and front and back-end sales loads from the funds themselves. More on this later. Funding alternatives. Only a dozen or so mutual funds may be available in workplace retirement plans. You might want more variety. Some brokers provide hundreds, if not thousands, of no transaction fee funds, as well as other types of funds such as ETFs. Tools for research and education. Greater options necessitate greater thought and research. It is critical to choose a broker that will assist you in learning more about a fund before investing your money. Simple to use. If you can't make sense of a brokerage's website or app, it's useless. You want to comprehend and be at ease with the experience.